Hello, I'm your mortgage lender, Rob, and welcome to 10 Minute Tuesday. This is a live and recorded video I host every few weeks where I'll be sharing real estate and mortgage news, tips, hacks, and updates all in 10 minutes or less. Q&A at the end, so if you're attending live, please drop your questions whenever you have them, or at the end you can also comment that you want to unmute yourself, and I will call on you to do that. So let's get started. Today's topic is vacating rental income and future rental income. All about rental income in general and how to use that to your advantage when buying a home. So first, as usual, we've got a quick rate market update. So we've got conventional and FHA, government, USDA, VA rates. Conventional in the about the 7.375 range, FHA, VA, USDA around 6.75%. We've seen things go up about 0.25% in the last couple of weeks. And really this came down to the markets are expecting another Fed hike probably this year. Numbers on inflation have come down as expected, not exactly where things were supposed to be or where they want them. I think the last CPI print was in the 3%. I know the Fed targets 2%. So they're going to probably do another rate hike. And then the question probably becomes not so much how high will rates go, but how long will they stay where they are? And potentially seeing rate cuts maybe next year sometime. No one really knows. But last month, July, was crazy, and we kind of are past the fallout of that and just in this steady increasing trend. So probably a little bit more rate increases and then probably holding unless something drastic happens in the market, such as a big spike in unemployment, which could see rates fall, or if we see another big spike in inflation where rates may go up higher. So always got to watch the markets. I'll be doing that, and you can keep tuning in for future news and expectations on that. Topic today, rental income. So we're going to talk about a few different types. So we've got first, vacating rental income. So what this means is if you own a home right now, or if you have a client who owns a home right now and they want to buy a new one, but they may not qualify for two mortgages because you have to qualify for all debt that's on your name, you can use something called vacating rental income, where you move out of your house, you get a renter, proof of a lease and a security deposit. Different requirements apply to different loan types. And then we use that future income that they would be receiving from the house they're moving out of to offset their existing mortgage payment. This allows you to essentially ignore one payment and only qualify for the new house when purchasing. So this is eligible for FHA, VA, and conventional loans, not on USDA, unfortunately. The way it works, just some rough math, is we take 75% of the gross rent. So if it's going to rent for $3,000 a month, you take, I think it's $2,275 as gross rent. So it's just added to your application, and generally you can't get more income than what your mortgage is worth. Details are not important here, but that's just how it works. Typically, you've got to show a 1-year lease and proof that the buyer or yourself, if you're the buyer, has received the security deposit and deposited into your account. That part's not applicable to VA in most cases. That's FHA or conventional requirements only. So that's future income on a property you're moving out of, your soon-to-be no longer primary residence. We've also got future rental income on investment properties. So if you're buying a property to not live in, or in the case of a multifamily, which we'll talk about next, with non-occupied units. So the way this works is kind of similar, only it has nothing to do with your existing house. It's looking at the future income potential of the house you're purchasing. So it's the income you will receive on a subject investment property. An investment property means you're not going to live there and you're buying it for the purposes of renting it out. This is only eligible on conventional loans because you can't buy an investment property on VA, FHA, or USDA loans. So it's conventional only. Up to 4 units, you can take the rent on all 4 units. Again, times 75% like the other one did. So we're going to get the appraiser to tell us what's the fair market rent on this property. We take the lesser of the fair market rent, or if it's already rented, the lesser of those two numbers, and we get to use that future income. And 75%. And then finally, a lease is not required if a unit is vacant. We're just going to use those appraisers' fair market numbers. Similar on so future rental income on a multifamily purchase. So this is similar to the last one, only now we're looking at a multifamily property, and because of that, FHA and VA loans can use this. That's because FHA and VA require you to live in the property. So if it's a multifamily property, like a duplex, up to 4 units, you'll live in one of the units. The other non-occupied units, we take the future rent. Very similar. We determine the rental income based on the appraiser's opinion and take the lesser of the fair market rent, or if it's already rented, what the current tenant is paying. Same thing, 75% of the gross rent received, that's added to your application, and the lease is not required if the unit is vacant. We just look at that appraiser's number. And then finally, a little note that is for FHA only, and this is something that we would look at property by property. So if you're a realtor watching this, then this is where I would work with you closely per property. And if you're a buyer, then I will talk to your real estate agent to make sure that a property fits this and we don't get hit at the end of the year. But it's something called an FHA self-sufficiency test. What that means is on an FHA property, if you're buying a 3 or 4 unit property, duplexes don't apply. So 3 to 4 units, we take the gross rent of all of the units, even the one that you would be living in. We take all the units and we just add up the rents, 100% of the rents. And the total income has to be equal to or greater than the total housing payment. That's including taxes and insurance. HOA wouldn't likely can be applicable because FHA wouldn't have a multifamily in a HOA. But if there is one, so total housing payment, all the property's rents added up must be greater than the payment. So that's just a little on top of it part for FHA. It does not apply to conventional or VA. So great way to do a few things. So if you're moving out of a house, then of course it helps you qualify for more. But if you're buying multifamily property, this allows you to qualify for a higher price than if you're buying a single unit because of those extra rents. Or if you're going to live in the property, you want additional rental income, but you can't qualify for the higher price of a multifamily property. This is a way to get a little extra income that'll be coming from the future rents of that property. So a fantastic way. We call it house hacking, where you can buy a property that you use a kind of live-in investment, rent out the other units. You have to live there for a year. You're committing to that if you're going to buy it owner-occupied. So you live there for at least 12 months. After that, you make the decision of when and if you want to move out and rent out your unit and then maybe buy another house for yourself. So fantastic strategy. I have not seen any questions in the chat, so thank you for attending. And if you have any future topics you want to request, just message me. My info's on the screen. Thanks for attending and have a great rest of your day.